not that what you want to hear. Trading is tough. And, it's like what I'm trying to instill in this lecture are ideas that aren't sexy. They're very simple. They're very robust, very timely, and they hold up over long periods of time. I've been trading since 1994. I've seen all kinds of markets. I've seen, or maybe of you have seen, where people were talking about peak oil and then the oil comes crashing down, or gold that's going to 5,000 and then comes crashing down. The whole idea is having a trading plan. And this is really what I try to instill and teach. I have a website called Trend Following Mentor. I teach. I also manage money. I also have a book called The Bible of Trend Following. And I guess as a free gift, because first of all, I appreciate all of you taking out time to come to this webinar. I have a book that I'm going to find here, hopefully. One second, and I'll send it to you for free. All you have to do is just email me. It's called The Bible of Compounding Money. I'll send you a PDF. Let's see if there it is. Here's the book. The forward was with Mark Faber, and really it's an experience, or my experience, of what it takes to compound money over long, long periods of time. And this is really what it's all about, is staying in the game. It's a marathon trading. And the issues that I'm going to discuss today my goal is to increase your trading returns and decrease the drawdowns. And this is really what, it sounds easier said than done, but there are definite ways to do this. And the first idea is my goal is to help you to become your own guru. Not to go watch CNBC or listen to that one or listen to that one. Be open, do not have an opinion, but you're going to have conviction at times, which is going to be interesting, which I'm going to get to. So before we begin, this is my website, Trend Following Mentor, and you can come to my website. I have a blog, and I talk about all kinds of things on my blog, trying to teach you, and actually you can see today's, and have all different ideas here, videos and everything. But let's get to the good stuff. Let's get to Metastock. Let me go start with my windows. One second. Let me see if I can minimize this, or I'll move this. Does this move? Yeah, this moves. Okay. Basically, I have an indicator, and what we discussed, or what was advertised, is I'm going to give you this for free. I'm going to give you this very, very powerful tool, which I call Andrew Abraham Buy. And as you're going to see, it's not perfect, because there is no perfect. It's a little bit choppy, as the markets are choppy, but it keeps you out of big trouble. What does big trouble mean? Let's jump to here. Let's talk about what happened. Let's talk about the really ugly stuff. Not 2011. Let's even get worse. Let's go to 2007 and 8. And I'm going to ask you with a show of hands, how many of you lost money in, let's say, 2008? If you can show, or just type in the little chat box that you lost money. If anyone can just type in there real quick. I'm curious. Okay. Point is like this. I'm using very simple tools. Back, I guess when I first started trading, I read about Dick Fabian, and he had the 39-week rule. And it prevented his clients from getting wiped out in 1987. So what I first do, because again, we're trying to increase our trading returns and decrease our drawdowns, I use a 200-day exponential moving average, which is part of this indicator right here. Then what I do is I use another moving average. And again, this is personal preference. I use a 30 period exponential moving average and a 10. Why do I say that? Because I know my personality. You have to know your personality. You have to know your fears, your greeds, or just your whole situation, because there is no magic number here. There's no magic anything. But the thing is, when there's a sustained move, as in this case, basically, you can be either out of the market or short. And I'm going to qualify that. Being short is very tough because you have a lot of volatility. Like you have a big moves going from here to here. But what I really try to do is when the times are healthy, and you can see healthy, because they're green and it says bullish, which also I will gladly give you this expert indicator called the Andrew Abraham. I don't know, I guess expert, even though I don't think I'm an expert. I don't think any experts are. But it'll tell you when you can be long. The first thing I want to add to this is the greatest amount of money that you can make in the stock market is in the beginning of a move. The question is, where are we in the move? Most bull markets last 2-3 years, so maybe 4, if that. The bull market that we're in, if you want to look from March of 2009, or you can even say after the flash crash in 2011, which that very sharp and volatile 20% drop, I rather look at it from 2009 March. This isn't, and I don't want to put opinions here, but the propensity to make money is diminished. The greatest money is coming out of a bear market. So let's just do a little recap. Increase your trading returns. You trade with the trend. This is the trend. And I use very, very simple indicators. I mean, when you look at Metastock, which is great, and I've had Metastock since 1994. I mean, in the beginning, I wanted to learn every single indicator because I thought I was finding the holy grail. I mean, you can see all these indicators. Well, guess what? Look at my screen. Look how simple my screen is. Pretty clean. So I want to trade with the market. I want to trend follow. Follow the trend. No opinions. I'm not going to listen to CNBC. I'm not going to listen to whoever. I'm going to follow exactly what it says. And then you know what? There are times, well, there's going to be big periods here. Look at this massive run. Massive. We can even tighten it up so we see it a little better. All of this, you have a green light to go long. But where we are now, it's really tough. It's been pretty tough all year. And if we look where we're at, basically you got in here, you got out here, you got here. Very choppy. But what is trend following? Trend following, as you've seen in these charts, you've seen you can follow the trend. So you have big profits here. And then when you have losses, you have small profits. Because there's only 4 possibilities when you trade. You can have big profits. You can have small profits. You can have big losses, which I showed you, which we can avoid just using this very simple rule. Not sexy, but simple and powerful. And you have small losses. So the whole point that we try to do is be available when there are these sustained moves. No opinions. Then you can get a little bit more, let's say, put your own little panache in there. Like right now, I know we're in this choppy period. What would make me bullish, I'd like to see that we really take out these highs. And that's why I have this line drawn in here. Again, not rocket science again. And you can see that the volume has diminished. The other thing, I'm a strong adherent of IBD or investors.com, Investors Business Daily. They speak about distribution days. How do you decrease your drawdowns? You monitor distribution days. Right now, as of yesterday, today's a new day, we had 7 on the S&P 500 and we had 6 on the NASDAQ. When you have a clustering of distribution days, which I'm going to, let's do the definition. What happens is there's a propensity for the market to fall down or turn. Hang on. And you can see them, 1 second, let me try to move this way. Distribution day is defined as the loss of more than 0.2 by a major index on increased volume, basically. And if you read IBD, they give it to you. They give you the answers. I don't just base it on that. I base it on my chart. So where are we at right now? We're hanging on to a long, maybe old bull market that maybe can become a super cycle. But I'm taking it day by day. And I'm not having an opinion. I just want to see that it shows strength or if it shows weakness. And right now it's not showing anything. So sometimes it's almost good to be on the sidelines. You don't have to be in the market all the time. So the first idea is we talk about the market. This is the most simple idea. And what you can do, it's not rocket science. Instead of, you can pick stocks, or you can see, like this one I did, the QLDs. They're a leveraged version of the NASDAQ 100. If you imagine, we can not even have to imagine, you bought here, simple rules. I gotta move this over. Let's say you bought here, which is your signal. You would have bought at, let's say, 35.35. You were long all the way up to 47.97. That's a pretty impressive move. And it's not rocket science. Again, you exit and you would take in it again. You can trade even the indices with this model that I'm giving you. Simple moving average or exponential moving average that are simple. You combine it with another rule, which I want to talk about, to stay on the right side of the market, is distribution days, which is a little bit more discretionary. But there was a money manager. His name was Marty Zweig. I don't know how many hundreds of millions that he was managing. And Ned Davis, they had a rule, the 4% rule. And that 4% rule, which I'll show you, basically, going back from 1965, made a compounded annual rate of 13.3%. Not rocket science again. What is the rule? It's right here. Some of the most simple things are so powerful. What it really says is that if you fall 4% from the highs on the on the value line geometric index, you're selling. You rise 4%, you're buying. It's trend following to the most simple degree. Here's the website right here. And you can even trade. Actually, I think there was one second, let's just see. No, that's his fund. But there's also where you can use this simple tool. In this model, I use both. I'm using the moving average rules, and I'm using this 4% rule that has proven itself and stood the test of time. It will keep you on the right side of the market. It will not every trade is going to work, but again, this is what trend following is. That when there are trends and you have the capacity, the psychological capacity, not to take quick profits or not to panic, that you'll be available to make these big profits. Look at this one. And they're there. So my first statement, to make like a summation, just going through my checklist, is to talk about the market. Then what I do is I always want to buy the strongest stocks in the strongest sectors when the market's healthy. I prefer to buy the market when we're coming out of a correction, because most people are scared out at that time. What we're looking to do is be a little bit different, not listen to the news and the doom and gloom. I remember March of 2003, right before the Gulf War, and all of a sudden the market took off from a terrible bear market. Who remembers March of 2009 when the whole financial system was going kaput? Well, you don't have to think. You just basically use a little bit of common sense and you watch these charts. And you can see them. Look, let's tighten it up a little bit. That's too tight. You avoid big problems, like here. You make yourself available for opportunities. And plus, as you'll note, my bars are red, my bars are green, and then I also have periods that are yellow. That's like indecisive. You can see them here. So, what I do, one thing I do is I just trade the indices. It's very simple. The QLDs, or you can trade the TNA, which is triple, rather volatile. But I also try to buy the strongest stocks in the strongest sectors when the market is healthy, which actually I have this open already. Some examples of some of these. Some of these stocks outperform Whoops, let's go here, 1 second. Let's talk about Skyworks. And look how simple my screen is. Let me just move this up. Greens, obviously, going long. Reds, some issues. Yellows, indecisive. But the thing is, I'm not just buying this way. I'm using very simple rules. I have a 10-period exponential moving average. I have a 50-period exponential moving average. And that is my line of demarcation. What I do is I do a combination of fundamental and technical. I look for stocks that are very, very profitable. Current earnings, annual earnings, and you can go look on IBD or you can go look on Yahoo. You will see stocks like Skyworks, extremely profitable. But you don't just buy them out of the blue or just I feel like it. You buy them with rules. And you can see how this is kind of written up here and it's kind of printed out everything. So what I do is I go through the Investor Business Daily. I look for stocks that have the strongest fundamentals, like this one I was in, Palo Alto. This stock, you can say from the breakout here, has basically doubled. It's done better than the indices. And it's even holding up better than the stock market. And this goes to the point that what we're trying to do. You go and you identify the strongest stocks and the strongest sectors. Let's talk about common sense again. Anyone reading the newspaper, everyone's talking about cyber hacks. Well, Palo Alto is the leader. Same thing with Skyworks. How many people have iPhones? They supply parts for the iPhone. It's going to almost like the Peter Lynch approach. Something new, something disruptive, something that your kids have to have. Like my kids had to have Decker shoes, these Uggs or Crocs. These things are all around us, these products. In the news, they talked about supposedly the Chinese, whatever government or whatever hacked into some U.S. government, whatever, and stole data. Companies like Palo Alto, that's good news for them. Their stock seems to move up. So you go through ideas that are interesting, that you can put your hands around. Let's use another common sense one. Let's talk about Tesla. How cool was Tesla? It's new, unique, it's breaking out like a rocket ship. But the question is, how do you get into it, right? So again, we have our rules. Actually, this is the 50. I don't have the 10 on here. I can put the 10 back on. I don't know why it's not there. Let's put it on. Just 1 second. Okay. So how are we identifying these stocks? One is when the market's healthy. I go to IBD, Investor Business Daily. I look at the IBD 50. I go look through their New America, cool ideas, disruptive ideas, and then you look to see how strong they are financial. And I have an Excel spreadsheet that was given by a colleague that actually you rank the stocks in IBD. You can also rank them from a technical standpoint in Metastock. Actually, I have, it's one of my, I think it's in here. 1 second, let me see if I have it here. 1 second. 1 second, exploration. 1 second, somewhere in here. But I like doing it with a combination from a fundamental aspect. So now it's going to get to the point where you understand the market, where you increase trading returns just by trading with the trend, with the market itself, and decreasing drawdowns several ways. I'm going to make a repetition. Moving averages, again, I will gladly give you this indicator, which is using moving averages and the 4% rule from Ned Davis, which has, again, compounded annual rate of 13.2%. You don't need to have a money manager. You can outperform so many money managers just with this simple tool. And then This is for the indices. And then I look at individual shares. And what I do is I set up a watch list. Where am I? Here we go. Of what I'm interested in. And I'm looking at them. These are like some of the strongest stocks. Like Cyber also does something very similar as Palo Alto. I go through them. And I look at them. And I have basic rules in order to buy them. So let's go to what those rules are. This is my tweet handle, trend follower at 9. And there's a Facebook group that I'm part of with Steve Burns. He forwarded this post that I shared with the group. And we're looking for, as it said in our, I guess, presentation, trading patterns. It's not rocket science. Here they go. There's all different. And the most common is a cup and handle. And I can either forward you this, or you can follow my Twitter, and it's here. And you print this and put it on your wall. It's real simple. And then you get to a point when you're trading. Let's go back to here. Whoops. Sorry. Let's talk about Palo Alto again. Here you go. Here's a cup. You buy. Guess what? Not every trade you're going to put on is going to work. What does it mean not work? What I first suggest, and suggest very strongly, how to decrease your drawdowns, have a preset stop. No more than you pick your poison. Is it 10%? Is it 7%? Is it 8%? Is it 5%? And you might get whipped around. But you know what? You're going to be in there for some nice long trades. So you have a stop, a hard stop. Again, in my case, and personally, it's 7% from the breakout. And not every breakout's going to work. And it doesn't have to work. Because again, we're trend following. We're keeping our losses small, making ourselves available, going back to what we showed you here. 1 second. If it's the S&P or if it's the NASDAQ. Mainly I'm looking at the NASDAQ because most of the stocks that I'm actually looking at are in the NASDAQ. So let's go. Let's focus on Palo Alto. So you had a trade here. You would have been buying, let's say here at 78, and then it went down to 74. You'd still be in the trade actually. Here's another one. Here's another one of these patterns. It's called a 3-week tight. Buy the breakout. You have a cups, another cup. All of these are here. And what you do is, again, what I talked about in the beginning of the lecture, or this discussion, there's only 4 possibilities. Big profits, small profits, big losses, small losses. Well, in the reality, what's going to happen is you're going to have rare big profits. You're going to have a lot of small profits and small losses. The goal to avoid big drawdowns is to have hard stops. Maybe it's 7% from your entry. Here they go. Go back to here. So if you have a small loss, big deal. 7% from your high. What is the idea to trend follow? What I do, you can see this 50-period exponential moving average. That's my line of demarcation. If it closes below it, something's wrong. You can kind of see here. And this could have been a point to exit. And then you know what? It's called a shakeout. Turns right around. You could have waited a day and see what happened. You could have had your stop at the low here of 87, let's say 73, which didn't hit, and it's kept on going. And you stayed in this and you compounded money. So what we're using is these patterns. We're using a hard stop of the 50-period exponential moving average. And then it gets down to the point, of, if you want to be so aggressive, you can add to your position. There's, let's say, investors that will add to their positions. Adding to your position doesn't mean if I have 100 shares, I'm going to add another 100 over here, another 100 over here, another 100 over here. What you can do, you can 20% of your positions, and you scale in. That's another way that you're decreasing your drawdowns. It's called a buy one, buy two, and a buy three. Buy one might be at the breakout. Okay, buy two might be 2.5%, 3% above the breakout. Buy three, or buy 0.3, or buy 0.2, let's say, could be 5% above. But you don't want to chase things once they started moving, because then you're enhancing your risk. And that's not what we want to do, because you enhance your risk, you're going to increase your drawdowns. So again, you scale into your buys, and then what you can do also, when you're right, if there's such a thing as being right, or well, let's make it even clearer. When the trade works, you want to be able to run with it. This is an example to make a lot of money. But also bear in mind, we potentially might be at the end of a bull market. The greatest times of these are at the beginning of a bull. Let's do Netflix as an example. Okay, back in 2000 and one second. Let's say in March of 2009. It was disruptive. It was something new, cool. Whoops, let's go. Where's my mouse? One second. That's great. My mouse is, here we go. One second. Let it open. Okay. Let's find 2000, and this has got to be it here. One second. That's 2011. 10, 9. Let's tighten it up a little bit. What's interesting also with Netflix, let's say, yeah, it got ugly. But you know what? People didn't stop watching TV or Netflix. It was in March of 2009. You basically, if you look from the lows here of 17, this stock rallied. During an ugly period, it basically tripled. It went from $17.94 to $50. So then you're saying, wow, something must be happening with this stock. Something good must be happening. And then you look at what you're doing. Here's a cup. Well, I don't have a buy here yet. I have a buy here. I'm above the 50. Go for the ride. Then guess what happens here? Good news came out. This goes on to something interesting too I'd like to just touch upon about gaps. Many people, they don't know how to trade gaps. Gaps aren't that easy to trade. But the thing is, here's a gap from 50 to 60 something. 60, it's almost 64, 63.85. And it was on tremendous volume. You could have waited a day, or you could have bought it here. The high of, let's say, 63.95. Gone for the ride. Look at this. 63, basically it doubled. Buying a gap. What you do on gaps, it's real simple. Where are my tools? One second, let me move this over. One second. I want to draw. Ah. Why not letting me? Let me do it this way. If you take out these highs, you buy. Once you close below it and close back in, you can buy. It's a very simple rule that was taught to me from the people at Investor Business Daily. But again, don't be afraid of gaps. Have your rules, the 7% stop or 8%. Because again, all of this has to match your personality. Or you buy the highs here. Are there any questions at this point? Let me just see if there's any questions. Because I know I'm trying to cover a lot of territory in a rather short period of time. If there's any questions, you can kind of type it in this box. Let's just see. Okay, doesn't seem so. Any questions? So let me continue. Let me just make sure there's no questions. 1 second. Okay. The other point I really want to talk about is the psychology of trading. It's one thing to hear lectures about this, and I want to first say again that trading is tough. And the way to avoid severe drawdowns that make you stop trading is by trading with rules. And the whole idea is making it, and this is going to sound kind of funny, making it to some degree a game. Take the money aspect out of it. Trade small percentages of your account size initially. Especially where we are at this end of the market, potentially. I mean, you have many, let's say, leading stocks that are topping. Maybe this is topping, who knows? I mean, this is a nice reversal on a lot of volume, which is not really what you want to see. But the idea is that to mitigate your losses will keep you in the game. And it will increase your trading returns, because when you least expect it, things will move. I mean, who would have thought here, this looks like it's selling off. You have another cup, ka-ching. It's pretty impressive. You know, here's your cup. You might have bought here. Let's see if you would have, let's see if it was here. No, just barely. And then you could say this is somewhat frustrating because then it gaps. But the other thing that many traders do, as myself, you can draw a trend line. You can say to yourself, okay, it couldn't stay below the 50-period exponential moving average. Started turning back up. And all of a sudden it started turning bullish here. And then look at this volume. Getting in a little bit early is risky. But it's another way to decrease your drawdowns. And this is really what the key is to try to mitigate your drawdowns, make yourself available for the unexpected moves. There are some shares, if you go back in history, if it's Monster Beverage, if it's Crocs, if it's Taser, you sit back and you go, I can't believe this is happening. But you have to stay in the game. Let's put Taser in there. That's an interesting one, actually. And using common sense again. All the news that's happening with the police and problems like that. And who's Taser's competitors? I think there's only one competitor, if I'm not mistaken. But you have these massive, massive moves. Boom. From 10 to 60% move in 6 weeks. You want to continue it? They're available. All the time there are these opportunities. Let's go back a lot further. Let me put this on the expert advisor. Makes it a little clearer. I don't know why it's not. Actually, it must have been prior, maybe the 2000 run. I don't remember when it was, but even this move from 4 to 8. So these are the basic ideas of trying to increase your trading returns. And I'm going to review everything again, even though it's on the video, and to decrease your drawdowns. 1, use stops. Don't think not to put a stop in. Again, if you can avoid the big drawdowns on a stock, because they don't come back all the time. Many times they just don't. If you can avoid the big losses, you're available psychologically and financially to take advantage of when there are moves. So mitigate your losses. To increase your trading returns, have a plan. What is the plan? Know where you are in the market at all times, which, again, we have this indicator here. Not perfect. There is no perfect. There are always going to be choppy periods like here. But you know which direction you're trading with the trend. Then what you need to do, which is not that hard, you don't just say, oh, I feel I'm going to buy XYZ stock, or I like XYZ company. You want to buy companies that, using the example of like Warren Buffett, that you'd want to own, that you want to be part of, that they're making a great product that's needed, and then you know what, just common sense, they're making a lot of money. Taser, as an example, common sense. They have a unique, and the other thing is read about the companies, research them. Don't just use everything technical. Metastock is a fantastic, fantastic tool, again, that I've been using since 1994, and the technical analysis is like an x-ray of what's happening, but you need to get a little bit of a fundamental story and combine the Peter Lynch approach, the mall approach, what are people buying, what do people need, what is a new and innovative product, and there always are new and innovative products that you can put your hands around. It doesn't have to be a drug company that's complicated, like, I don't know if it's Gilad or Horizon or if it's Jazz Pharmaceuticals. Something that you understand. It could be a clothing line. It could be a shoe line. I mean, they're there. They're all the time. Trades like that. Then what you do is you look for these patterns that we talk about. You have a cup and handle. And when you look, what I suggest is, I can email you this, or you can follow me on Twitter and you have it. Tape this to your wall. Look for these setups. Flat base, square. These are the most common. The cup with handle, the saucer, the double bottom is also very, very good. It's also like, I guess it's a takeoff of Jesse Livermore, where he calls it a shakeout plus 3. Actually, it's even written here. Buy point if on, buy volume, shakeout plus 3, where you have a low and a lower low, and then you come back on volume. Flat base, high tight flag, those are very rare. These are rare. The main ones that you're going to see over and over and over again are here. They're always available. And you might miss the first one. But you know what the thing is, you don't want to chase when these things are already so extended and run up. Like, again, if we want to talk about, let's say like this. Look at this move. It went from 20 to 190. 9 times it moved, 900%, and look at this period of time. This is the idea that you want to be available. And you know what? You had a lot of opportunities to get back into this. Let's say you missed it in the beginning. Let's look at it, some of these patterns. You went from basically 34, ka-ching, up to 100. Wow. Then you had a consolidation. This is a 3-week tight. Takes off. It's a little bit frustrating. It turns down. But then it just keeps on moving. You had another point here. Cup. Boom. A little bit frustrating here. Nothing's going to be easy. Another cup. But once it's already gone up so much, your odds get dramatically diminished and your risks become enhanced. Look at what happens here. Goes up and then kind of consolidates and kind of putzes out. But what's interesting too, look at the power of just using trend lines. And you can even say you have, again, a double bottom here. And you can be buying here, it breaks the trend line. And you could have been buying at 200 and now it's 266. If the fundamentals hold up, that you want it to be so extremely profitable. And some of these shares, they're up, the financials, and you want to see increasing earnings quarter over quarter over quarter. And they happen. Again, if it's Palo Alto, yeah, opportunity after opportunity after opportunity. Here's another opportunity. So wrapping it up, make it just another review. First thing is I suggest look at the general market. Where are you in the market? Use very simple support and resistance lines on top of this. Right now you're on a buy, but you've been getting chopped up. You want the market to, show its hand a little bit. If you don't want to go and start picking stocks, which is difficult, where you don't have the time, you can use this very simple rule, and you can get a very nice compounded annual rate of return over time. Take this indicator, give it to you for free. No strings attached. Because why am I doing this video? I feel it's a way of giving back. Metastock gives me the program. I use it. I teach my students how to use it with Metastock. I've used it since 1994. It's a great product. It's a way of giving back. People have helped me throughout my journey. And my journey's been tough. It's been very tough. And actually, you know what? Once you think you get it, it stays tough. Because I trade stocks and I trade commodities. And my commodity trading has been rather tough the last couple of years. And it's been tough for many other CTAs. Maybe because all the artificial QE2, 3, 4, who knows, whatever. But have a plan. You can use this first to see where you are in the market. If you're above a 200 period exponential moving average, you don't want to start looking to short. You want to be looking to buy strong stocks fundamentally that are breaking out. This is how you increase your trading returns. And you look at Investor Business Daily. Let me open one and I'll show you. It's real easy. One second. And I keep all the newspapers on a daily basis so I can go back and learn from them. Oops. Let's go here. And there's the IBD 50. Let me show you what I mean. And they almost give you the answers to some degree. It's really cool. This is a great article, which they talk about companies, the new America, because it teaches you about companies that you never knew about or never heard about. But let me show you the IBD 50, where I get a lot of my ideas. And I'd strongly suggest you subscribe. I mean, nothing of that comes to me. But, one second. And I read Investor Business Daily every morning on the treadmill. Let me kind of move this over. So you can kind of see, like they said, forming a cup-shaped base with a 49.28 buy. If you can see this, earnings last quarter were 74%, 44%, 26%. Earnings estimates are plus 60%. That's pretty impressive. So you're looking to buy, they're giving you ideas of companies to look at to do your research. Palo Alto, this one, Skyworks, even though it's a late stage breakout, 5% extended over the flat base. We talked about these flat bases. Here they go, right here. And you go through, doesn't take very long. One second. Oh, and even it's interesting, they're talking about distribution days. And right now, again, we have 7 of them and 6 of them, respectively, on the NASDAQ. But you look through these stocks, and then you get ideas. 1% by the buy point. Okay, buy point. They tell you flat base. And you go to Metastock, and then you just enter it, and you look at it. And you know what? They're here. The opportunities abound. This was written about in IBD, but I don't need IBD to tell me. I can see it. Bought the breakout right here. This was a nice move. And then you can add to your position when it breaks out again. Or you can add to your position when it touches the 50-period exponential moving average and recovers. I mean, imagine you bought it at 140, now it's 178. But you don't buy the full position. That's another way, again, to decrease your drawdowns. Let's say you bought 100. You scale into it. You have your buy 1, buy 2, buy 3. As it's moving up, you're adding to your position. If it's working, you're adding. And then when you have opportunities, like a 3-week tight or another cup and handle breakout or a retracement, you add 20% of your shares to your portfolio, and you're compounding, and when the trade works, this is an amazing trade. And I want to qualify again. The beginning of a bull market, when everyone is so negative and so pessimistic, is where there's the biggest returns. And combine that with just reading this. It's pretty easy. It's fun. I love it. And you learn about businesses. And let me just see if there's another. Here, this is another section. Mobileye. And they talk about all these things. And they talk about, here, extended nearly 9% after cup and handle breakout of 48. Bought it at 48 and now it's 53. And you look at the earnings, 19%, 33%, 60%, 28%. I have an Excel where I combine all of these earnings growths, earnings per share, annual earnings, and all these things. So I rank them. So I even figure out from a fundamental standpoint which potentially could move. And the idea is that you look for the most financially strong companies. But that's a fundamental thing. That's what you put into part of the matrix in order to increase your trading returns and decrease your drawdowns with Metastock, with the tools that I've been speaking about. So just a quick, one more last thing. I definitely suggest you download this. Let me just see if I can put it in here, if it works. And you can copy it. Or you can follow my Twitter feed. That's me. Let me just click on it. And you'll see all these. I want to say thank you for coming to this webinar. If what I do, let me just make a little, I guess, little presentation of my website. What I do is I do one-on-one mentoring. I teach, because it's not just one thing to say, okay, here's the Holy Grail, even though there's no Holy Grail, of what we just discussed. A lot of it is I hold hands with my investors / traders how to do this. So what I do is I have my book, The Bible of Trend Following. It's on Wiley Books or on Amazon. This book, email me, I'll send you the book free. I have personal one-on-one mentoring hourly. I have a course. I also do one-on-one mentoring on site, mainly for companies. But the idea is, if I can help you in any way, please let me know. And that's pretty much it from my side. I'll turn it back over to Jeff. Jeff, can you hear me? Jeff?
I can.
Okay.
Yeah. Do you want to take a couple questions?
Sure. Let's do it.
Testing. Hello.
I hear you.
All right. A couple questions coming in. Can I ask a couple questions? So if people want to get hold of you, what is the best? What's the email address that you would like them to use?
Here it is, right here. Oh, and the other thing, it's best not to call me because I travel a lot, and sometimes my time zones get a little bit whacked out from either the U.S. or Europe. I mean, sometimes I'm in Asia, sometimes I just came back from London this afternoon. So the best is to email me, just andrew@trendfollowingmentor.com. And that would be the best way for me to help you or correspond with you or just get you up and running in any way, shape, or form.
Okay, and I posted that in the chat as well. I didn't know if you and I will attest to that. Every time I talk to Andy, he asks me to send me the email, so it is actually a pretty good way to get a hold of him. Let's see. Ken asked a couple times, why are you using the Ultra QQQ rather than the regular QQQ?
Okay, great question. It's all personal preference. There's no magic for anybody. You can use either one. What I believe, if I'm looking at the NASDAQ 100, which both mirror, I'm going to get more bang for my same money if I use the QLDs. It's a double-edged sword. I'm going to have a greater return, and I could have greater drawdowns. But I'm also trying to, as much as people say you can't time the market, well, Marty Zweig and Ned Davis sure did a pretty good job of doing it. They avoided the big drawdowns, that 13.3%. And I'll pull it up again, and I'll put it into the chat. 1 second, yeah. Here's the link. And I combine that, again, to match my own personality with the moving averages. But I definitely suggest you read this article. It's things don't have to be complicated. Simple works. Simple holds up over time.
I would agree with that. Frank asks, how do you determine the strongest sectors or industries?
You can do it, you can rank them in Metastock, or I do it just even, it's simpler for me, is I go through here, let me just open up an IBD. They shoot you the answers again. Hang on. You can see, well, it's in the newspaper actually. Let me try to get to it somewhere. They show you the sectors, but then I'm talking common sense, which isn't so common. Let's say some of these shares, we're talking Palo Alto or we're talking CyberArk, and I'm not recommending them. That's first of all, no. But the thing is, just think about all the cyber break-ins. I'm trying to find it. Maybe I'm too far. Maybe I am. But they tell you in the newspaper, actually, which are the sectors. Or the real simple thing you can do in Metastock from a technical standpoint is you do it's like an average of 3 periods of average true rate of like a rate of change, like 3 periods, and then you identify them. You can make those periods either stronger or weaker, but instead of doing that, I just go through the paper and I'm just trying to use common sense. Like Taser, it's common sense. Sorry, this thing isn't coming up so quick. Let me just try to print it out of here. And you can see the companies. They'll tell you the group ranking. It's somewhere in these little pictures. You have 99, 99, 90 relative strength. But they also say the group somewhere in here is the group. Or at least I think they do. So that's what I primarily do to answer that question.
I might add to that in Metastock 13 they added a product called Sector Stat.
Okay.
It's pretty cool. I looked on YouTube, and unfortunately we haven't recorded a video on how to use it. We should do that. But the Sector Stat program that's in Metastock is really, really cool. It's something I use on a regular basis to determine sectors and industries.
You can do the same thing with an average rate of change. I'm looking for the indicator. I just haven't used it for the longest time. But basically you look at 3 periods, rates of change, and you average them, and the point is to smooth them out. You know what? Let me just do a search on my thing here. If I have it, I'll post it. 1 second. Well, you know what? I'll tell you what. If you email me, I have it here, and you can actually put that in as an indicator in Metastock, and then here, ranking, bingo. I think I got it. Maybe. Nope, that's somebody else. 1 second. Bear with me. I have it here somewhere. The best is to email me, and I have the actual indicator, and I'll give it to you. And you just use it as a what do you call it? In a what do you call it? In a exploration, and then it tells you, it ranks the markets, it ranks the sectors, it ranks the currencies, it ranks whatever you want it to rank.
Okay, that looks like the end of the questions. Thanks, everybody. Anything else you want to say to close this thing up, Andy?
Nope, I just want to thank everybody for attending, and I guess the point is, whatever I can do to help, please let me know, and the best way to reach me is via email. And I want to thank you also. Thanks for having me.
Of course. Thanks for coming. Thanks Andy for coming, and thank you guys for coming. We'll see you at the next one, and have a great weekend, everybody.
All right. Thank you for having me, Jeff. Appreciate.
Oh, of course. No problem. Anytime.
Okay. Bye. Thanks.